In a rare piece of good news from the Australian Tax Office for Australian expats, the tax rates have been cut. On the 1st of July 2024, the new non-resident tax rates for Australians overseas have come into effect. So in this video, we're going to dive into exactly what these tax rates are, what they mean for us as non-residents, and 3 common scenarios that a lot of Australian expats face in terms of how we need to think about and consider these new tax rates. So let's dive right in. Hi there, Jared Brown here, Australian Expat Financial Planner. Today we're talking about the new tax rates that are in effect from 1 July 2024 in Australia. These are the non-resident tax rates that basically apply to your taxable Australian property. So if you have capital gains in Australia, you have rental income in Australia, these things remain taxable in Australia. So the first one is the new tax rates. The first tax rate, or the starting tax rate, has dropped from 32.5% to 30%. And the threshold has also increased from 120,000 to 135. So what that means is that if you have taxable income in Australia of 135,000 in one financial year, we can now save $4,050 relative to last year. Now from 135 to 190, the rate is 37%, and above 190, it is 45%. Now it's important to note that there is no tax-free threshold for non-residents. That has not changed. We do not get the $18,000 tax-free that you would normally get as a tax resident in Australia. So an important one to note, no change this financial year, just one common question that we get from a lot of Australian expats, particularly new non-residents of Australia, wondering where that tax-free threshold has gone. It has basically never been there for expats, and it certainly isn't coming to effect anytime soon. Now with these new tax rates, what do we need to think about? Well, there are 3 common scenarios that we need to strategize around when it comes to these tax rates. Number 1, now this applies to those who have a rental property or rental property portfolio in Australia that are generating positive cash flow. So let's just say that after your costs, your rental income or your positive rental income is $20,000 per year. That means that you're getting rental income coming in, you're paying out your management fees, council rates, water, land tax potentially, all of the other costs that are involved, and we have a net figure left of $20,000. Now instead of paying 32.5% on that $20,000, we're now going to pay 30. So, all right, it's not life-changing, but we save $500 a year in tax that we no longer need to pay. So it's certainly a step in the right direction and good news for Australian expats. So that's number 1, just be aware of that tax saving when it comes to your rental income each year. Now, number 2 is if you have a capital gain in Australia as a non-resident. So if you're thinking of or have been considering maybe selling an investment property or selling something in Australia that remains taxable in Australia, the tax bill will now be lower than it was selling last financial year. As I said, if it's $135,000, it's a saving of $4,050. So if you were thinking about selling property or some other taxable asset in Australia, this financial year may be a better time to think about it. For most people, waiting until they're back in Australia as an Australian tax resident is far more tax effective for selling properties or selling other taxable assets, but that is not always the case. So run your numbers and work out what's best for you. Now, number 3 is really around unused or carried forward tax losses. Now, we hear this a lot of time from Australian accountants or from Australian expats who are speaking to their Australian accountants and telling them, look, you've already got all these losses from your property from previous years, all the negative gearing, and you've got $10,000 or $20,000. Let's use $20,000 worth of losses that we can just offset the rental income with. We don't need to contribute to super. We don't need to do anything else. We'll just use those losses. Now, that is, in isolation, correct. It is not false information. You can use those losses to offset the rental income. Now what that means is that that will save you 30%. So each dollar of those tax losses is working for you at 30% or saving you 30 cents in the dollar. Now, nothing wrong with 30 cents in the dollar, far better than a kick in the teeth. But what if you plan to go back to Australia and earn $180,000, $200,000, $500,000 a year? Well, now those losses that we could have used then, we used before at 30%, they could have now been utilised at 47. So don't rush into utilising carried forward losses. They can be an incredibly powerful tool to be used later on, particularly if you do plan to go back to Australia and either work in Australia again, or if you plan to sell other investment properties or other assets where there is going to be a large tax bill. So as I said, good news for Australian expats, but certainly things we need to think about when it comes to our tax minimisation strategies going forward under the new regime, with the first tax rate starting at 30% going forward. Thanks for tuning in. Drop me a note with any questions at all. If you'd like to book in a chat, you can do so in the notes. Look forward to seeing you in the next video.